Welcome back. Our next guest is an investing professional. He's got a positive outlook on both stocks and bonds, although he is underweight in his portfolios on Canadian equities. He'll explain. Sadiq Adatia is CIO, Chief Investment Officer at BMO Global Asset Management. Thanks for coming in.
Thanks for having me.
Why are you bullish, broadly speaking, on equities this year?
Well, I think, the economies around the world are still in relatively pretty good shape. And though we are seeing the consumer weakening, we don't think they're actually weak. And therefore, I do think you're going to continue to see spending continue, as expected, maybe different choices by the consumer. But overall, I do think that we're going to be in an environment where equities can still outperform. Bonds will probably do much better as well as we start seeing rate cuts occurring as well. So overall, a pretty good year for both equities and bonds. NASDAQ
Composite was up 2% yesterday. So investors, at least yesterday, thought there's more room to go in these tech valuations. What do you think?
Yeah, I agree with that. I do think tech is a story that's not just for 2024. It's for much longer than that, particularly the key tech names that are tied to the themes like AI, cloud computing. Those are the type of things that you want to play out for much longer. But I do think that given what we saw last year, and we're hopeful that this continues for again this year, but I would say that last couple of months of 2023 were driven by a Fed pivot.
Right.
That pivot went from rate hikes to should have been rate pause, but it went directly to rate cuts.
Right.
And so I think the market is getting a little bit too far ahead of itself in terms of how quickly rate hikes cuts will occur and how many will occur. And that's why I think you're seeing a bit of that volatility right now as the market kind of digests that. It won't be as quick as maybe they're expecting.
What will you be listening for when first the bank CEOs and top executives in the U.S. deliver their outlooks this week, and then in the weeks ahead, other big companies in the U.S. deliver their guidance?
I think the first and most important thing is really the health of the consumer, right? We want to see, is the consumer changing their patterns, and if so, how much? What is going on with consumer debt? Are we seeing more credit card, balances going up? Are we seeing the appetite for mortgages come back? Those are the type of things that tell you the consumer is still spending, but now as opposed to using savings, they're using their credit, which means, again, the economy can still move forward. Not necessarily great for the consumer, but definitely still okay for the economy. Those are the type of things. Low loss provisions is another one we want to watch for carefully. And then just generally the comment about, where the investing is continuing to go forward as well, too. Because, if you're investing still in continuation of growth, that means you're feeling a little bit more optimistic about where things are going. If you're cutting costs, you're hashing down a little bit more on a tougher environment that you might see going ahead.
You're underweight Canadian equities. Is that a call on the relative weakness of the Canadian economy versus the U.S. economy?
Yeah. So what I would say, all of last year, same thing. We were generally underweight Canadian equities, and it's driven by a couple of things. One is their U.S. counterparts are much healthier from an economic perspective. Also from a consumer's perspective. The Canadian consumer has a lot more debt than the U.S. consumer does. So the impact of higher interest rates impacts them significantly more than the U.S. And secondly, I actually don't think that the Canadian consumer has fully been impacted by the higher rates quite yet. Mm-hmm. Let's use the mortgage environment as an example. Renewals are still occurring. So people are still under that 2, maybe even 1.5% mortgage rate. In the next couple of years, a lot more of them are going to get the impact of 6% rates. And that's going to definitely impact how they spend going forward. Again, that impacts GDP, that impacts what corporations are going to have on earnings, and that could have an impact on employment. And we're already seeing unemployment start to go up in Canada, not like we're seeing in the U.S., right? So that's the difference between Canada and the U.S., hence why we're being a little bit more cautious in Canada. You
don't see a material decline in mortgage rates coming over the next couple of years, do you?
So I do expect mortgage rates to come down, but I think what people have to remember is, you're at 1.5% or 2%. If you renew today, you're at about 6, call it.
Yeah.
But if you renew in a couple of years, you might be at 4. You're still going to increase that amount by double on your interest portion of it. That's still going to take into your consumer spending patterns, and therefore going to impact the economy, right? So hopefully it's at 4 and maybe even lower, but you still have to assume that maybe it doesn't because Macklin is still a little bit hawkish on his statements, right? So you don't know when that rate cut is really going to actually start.
Gold outperformed late in 2023 and is still holding above $2,000 per ounce. Do you like gold?
We do like gold. I think gold is a good defensive play. We expect more volatility this year, so gold should do better on that. Generally, if you think about what happened in August, September, October, we were underweight equities, which was great. But our gold position really benefited us as well. Markets were down about 7%. Gold was up about 7%. It gives it back a little bit in November, December, but by that time your equity weights are overweight and you can offset some of that. So think of it more as a hedge, a defensive play. I also think people are still looking at alternatives to currencies, and sometimes they're still moving towards gold. So to me, gold still has room to go higher from here, but we're playing it more as a defensive hedge than anything else.
Okay, we've got about a minute left. Why don't we finish with emerging markets? A lower U.S. dollar tends to be good for emerging markets, but I think you're cautious on that part of the equity landscape.
Yeah, actually, we think the U.S. dollar is going to be stronger. Again, with this higher volatility, the fact that I think Bank Canada cuts a little bit faster than U.S. does. So I do think that's going to be still relatively strong. That's a little bit of a headwind for emerging markets. I don't think China's out of the troubles that are in. The property sector still having a little bit more difficulty. I do think things are stabilizing there, so definitely that's a positive. And I think other parts of emerging markets like India and Mexico are benefiting off the problems that you're seeing in China across the board. So it's not one that we want to take too much risk off or add too much risk on, because it could spike at any point in time. So we're kind of neutral on the emerging market region today.